Welcome student. In today video lecture section, we are going to start another practical question for unit costing. There is question number 6. Kausal Limited manufactured and sold 4,000 units of TV set at its 50% production capacity in the year 2016. We remember there is a 50% production capacity. It means if company product manufacture at 100% level, then company can get manufacture 8,000 units of TV. But here company utilize only 50% its capacity and manufacture and sold 4,000 TV sets. There is a cost of material per unit rupees 80, wages 50% of material consumed, direct expense rupees 80,000, factory overheads rupees 2 lakh. Out of 2 lakhs, 60% is variable nature and remaining is fixed nature. Office overhead rupees 1,40,000, which is 100% fixed, and selling overhead rupees 1 lakh. Out of 1 lakh, there is 40% is a variable part, and so remaining 60% is considered as a fixed part. Sales, there is a sales is cost plus 10% profit. For the year 2017, it is estimated that first, the output will be at its full production capacity and 75% of the production will be sold. We remember in the 2017, company will manufacture 100%. It means 8,000 TV sets, but company can sell only 75% production. It means 8,000 multiplies 75%. It means I think it will be 6,000 units. Number 2, cost of material and wages will increase by 20% and 10% respectively. Number 3, fixed factory and office expense will increase by rupees 40,000 and 20,000 respectively. We remember there is a fixed factory and office expense. It means in factory overheads and selling office overhead, there is a fixed nature increase. Number 4, the rate of profit on cost will increase by 100%. From the above information, prepare the following statement. Number 1, a statement of cost showing total as well as per unit cost and profit for the year 2016. And number 2, a statement of cost showing estimated profit for the year 2017. Now we check answer of the same question. First one, answer number 1, cost sheet of Kausal Limited for the year 2016. As we read or show in question, there is a manufacturing 4,000 TV sets and sold 100%, means 4,000 TV sets. Now start from material consumed. Here direct material given. Direct material given in unit wise, it is unit rupees, it is 80 rupees per unit. So in total amount, it will be rupees 3,20,000. How it is? There is 80 rupees multiply 4,000 manufacturing units. Then direct wages. Here direct wages is 50% portion of material consumed. There is a material consumed rupees 80, or in total amount rupees 3,20,000. So 3,20,000 divided by 50, or a 80 divided by 50%. Answer remains same. There is per unit rupees 40. So 40 multiply 4,000, it will be 1,60,000. Then direct expense, which is rupees 80,000 in total amount. So 80,000 divided by 4,000 units. So it will be rupees 20 per units. So direct material plus direct wages plus direct expense, they all are a manufacturing production expense, or it is a basic expense for production. So it is considered as a prime cost for production. Total in unit wise rupees 140 and in total amount rupees 5,60,000. Now, as per default rule, we should added a factory overheads. There is a factory overheads rupees 2 lakh in total amount, but out of 2 lakh there is a 40% is variable portion, sorry, fixed portion, and 60% is variable. So we divide in nature wise. So 2 lakh into 40%, it will be rupees 80,000, and 2 lakh into 60%, it will be rupees 1,20,000. Now we calculate in unit wise. 80,000 divided by 4,000 units. So it will be 20 rupees per unit. Same way, 1,20,000 divided by 4,000 units. It will be 30 rupees per unit. Then factory overheads should be added into prime cost. So we get factory cost or a works cost rupees 190 in total unit wise, and rupees 7,60,000 in total amount. Then we have to add office overhead. There is office overhead rupees 1,40,000, which is 100% fixed. So 1,40,000 divided by 4,000 unit is equal to 35 rupees per unit, which is added into factory cost. So we get office cost or a cost of production. In unit wise, it will be rupees 225, and in total amount it will be rupees 9 lakhs. Then add opening stock of finished goods and less closing stock of finished good. But there is no opening stock or no closing stock, because in 2016 company manufactured 4,000 TV sets and sold all 4,000 TV sets. So there is no remaining stock in units. So there is dash dash. So production cost of goods sold remain unchanged, 225 unit wise and 9 lakh in total amount. Then we have to add sales and distribution expense. Sales and distribution expense total given in 1 lakh rupees, but out of 1 lakh there is 40% part is variable nature. So remaining 60% is considered as a fixed nature. So 1 lakh into 60,000. Same way, 1 lakh into 40%, 40,000. So 60,000 is a fixed and 40,000 is a variable. So 60,000 divided by 4,000 sales unit, 15. 40,000 divided by 4,000 sales unit, 10. Now this sales and distribution expense is added into cost of goods sold. Then we get total cost rupees 250 in unit wise, and in total amount it will be rupees 10 lakh. Sales and profit. Here given there is a profit percentage is 10% of cost. Here cost rupees 10 lakh. So 10% of 10 lakh will be rupees 1 lakh, and 10% of 250 will be 25. Then profit should be added into cost. Then we get sales 275 unit wise and 11 lakhs in total amount. So this way we prepare a cost sheet for the year 2016. In next year 2017, company wants to produce production at its 100% capacity, but company can sell only 75% production in the year 2017. So first we have to make a work note how many units company can produce and how many units company can sell. Here, as per data given in question, company utilized only 50% capacity in 2016 and company can manufacture 4,000 units. So 100%, then what? Then your answer is 8,000 units. But there is estimation sales in 2017 is 75% of production. So 8,000 units multiply 75% is equal to 6,000 units. So closing stock for the year 2017, 8,000 units less 6,000 is equal to 2,000. We remember in 2017 company will manufacture 8,000 units and sell 75% of manufactured units. It means 6,000 units company company can sell. So this way there is a remaining stock in unit 2,000 in 2017. Now we prepare estimated cost sheet of Kaushal Limited for the year 2017. Manufacturing units 8,000 TV sets and sales unit 6,000 TV sets. Sheet as per above cost sheet. First one, direct material, which was 80 rupees per unit in 2016. But in 2017, there is an estimation 20% increase in material cost. As per default rule, material is a variable nature expense. So if material value is increase or decrease, then it is always calculated on unit wise data. Here unit wise it was rupees 80 in 2016. So 20% plus of 80 rupees, which is 96 rupees in total amount, which will be 96 rupees in total amount. So 96 multiply 8,000 will be 7,68,000. Then direct wages. Direct wages rupees 40 or a 50% of material in 2016. But in 2017, there is a information direct wages cost will be increased 10%. Direct wages is also a variable nature expense. So there is a calculation of increase on unit wise data. There is unit wise rupees 40 in 2016. So 10% of it rupees 4. So 40 plus 4, total rupees 44 per unit in 2016. Sorry, 17. So 44 multiply 8,000 is equal to 3,52,000 direct expense. There is no instruction or no information for direct expense, so it will remain unchanged. But direct expense is a variable nature expense. So as per default rule, variable nature expense remain unchanged, then it will be unchanged in unit wise. As you seen in 2016 cost sheet, direct expense rupees 20 unit wise. So here it will remain unchanged in unit wise rupees 20. So in total amount 20 multiply 8,000. So it will be 1,60,000 in total amount. This way we will get prime cost rupees 160 per unit and 12,80,000 in total rupees. Then we have to add a factory overheads. There is factory overheads fixed and variable nature. As per information number 3, fixed factory overhead and office fixed overhead will increase by 40,000 and 20,000 respectively. In 2016, fixed factory overhead was rupees 80,000. In 2017, it was increased by 40,000 rupees. So as you seen on screen, there is 80,000 plus 40,000. So total expense, fixed factory overhead expense rupees 1,20,000. So it will in unit wise 1,20,000 divided by 8,000. Variable nature. There is no instruction for variable nature expense in factory overheads. So it will remain unchanged, but it will remain unchanged in unit wise because it was sorry, it is a variable nature. We seen in 2016 sheet there is a variable nature factor at rupees 30 per unit. So it will remain unchanged for 2017, 30 rupees unit wise. So in total amount, it will be 30 multiply 8,000. So 2,40,000. Now this factory overhead expense, we have to add it into prime cost. So we get a total factory cost or a work cost rupees 205 in unit wise and 16,40,000 in total amount. Then we have to add office overhead. There is office overhead 100% fixed in 2016. Same, it will remain fixed in 2017. But as per information number 3, there is office overhead expense will increase by rupees 20,000. So it will be rupees 1,60,000. How it is? There is 1,40,000 in 2016. In 2017, it will increase by 20,000 rupees. So 1,40,000 plus 20,000. So it will be rupees 1,60,000 in total amount. So per unit 1,60,000 divided by 8,000 units is equal to 20 rupees. Then office overhead should be added into factory cost and we get office cost or a cost of production 225 in unit wise and 18 lakhs in total amount. Now we have to add opening stock of finished goods, but in 2016 there is a manufacturing 4,000 units of TV sets and sells also 4,000 units of TV sets. It means there is no closing stock in 2016, so it means there is no opening stock in 2017, so dash. But there is an estimation in 2017 production of 8,000 TV sets at 100% capacity, but there will be a chance or estimation there is only sells 75% of production. It means 6,000 TV sets company can sell in 2017. So there is a possibility of 2,000 TV sets remain in stock. So here closing stock of finished goods 2,000 TV sets or a units multiply 225. So 4,50,000 is a closing stock of finished goods in 2017, which will be less from office cost. So now office cost rupees 13,50,000 per unit 225 remain unchanged. Sales and distribution expense. There is sales and distribution expense in 2016 was rupees 1 lakh, but out of 1 lakh there is a 40% variable and 60% fixed. But in 2017 there is no information about sales and distribution expense. So both nature, fixed nature and variable nature remain unchanged for 2017. So as per our default rule, if fixed nature expense remain unchanged, then they will remain unchanged in total amount. Same way, if variable nature expense remain unchanged, then they will remain unchanged in unit wise. First we saw we see in cost sheet of 2016. There is fixed nature sales and distribution expense was rupees 60,000 in total amount, and in variable nature it was rupees 10 unit wise. So now for 2017 fixed nature expense remain unchanged in total amount rupees 60,000. So 60,000 divided by 6,000, it will be rupees 10 per unit, and variable nature expense remain unchanged in unit wise, which was 10 rupees per unit in 2016. So here it will remain same 10 rupees per unit. So 10 into 6,000 sales unit, so 60,000. Now sales and distribution expense should be added into cost of goods sold. So we get 245 is a total cost, and in total amount, total cost rupees 14,70,000. Now profit and then sales. As per information number 4, there is a rate of gross profit will increase 100%. In 2016, rate of gross profit was 10% of cost price. So there will be 100% increase. It means now it will be a 20% on cost price. Here cost price rupees 245 per unit. So 245 multiplied 20%, which is 49 rupees per unit. So there is a profit rupees 49 per unit. Then profit per unit multiply sales unit 6,000. So 49 into 6,000, it will be 2,49,000. Now profit should be added into total cost. Then we get sales rupees 249. So total sales 17,64,000. Okay.